Today in TFC Stock Geek Out, we're going to explore a company where you run and exercise and get fit. Some people call them the pandemic play, and let's be real, during the COVID period, they did grow very, very fast. But going forward, they are more than just a pandemic play. They aim to take over your gym membership, right? They want to be of so much value that you will stick with them and not with your gym membership. So it's not a foreign company. I think a lot of people will know. They are in the media circuit, and that's where we're going to find out. But they have been going around with a lot of supply chain issues. The share price have been tanking. I think it's come down by 40%. So the question is, can they, sort out their problems and get back to growth stage? And our friend for today has a very, very interesting story structure for us. Okay, so joining me today to geek out on this fitness company Peloton is Max, right? Max Co. You can find him on Twitter at HeyMaxCo. Okay, he also has a Substack. Just go and search his Twitter account. And he has a very interesting story because he was like a super bull for Peloton, but he's recently released all his positions. So now he says that he's not a bear, okay? He's just neutral, coming back to try to figure this company. And I think that's an interesting story, right? How does an investor go from being super bullish about this growth company, but then after a while, kind of tweak their perspective and essentially shed his position? So it's not exactly an easy share. He lost a little bit of money. But for all that and more, you should join us today. And of course, you can go and reach out to him to talk a little bit more. But today we're going to focus on how Peloton is struggling with some of their growth initiatives. Where is their future going forward? And of course, the most important thing is how Max structures his portfolio and what is the reason behind he being so bullish. He's going to give you a super bullish case for like 45 minutes and then sell the stock, sell his position. For your reference sake, this episode was recorded on the 16th of December 2021, and it does not serve as any form of recommendations to buy any stocks. It's only for entertainment and education purposes only. Thank you for loving what we do and empowering us financially to do more for you. So let's geek out. Welcome back to the show today. I'm very happy to have a new friend on the show, right? So Max, you want to introduce yourself for all the listeners tuning in today?
Okay, hello folks. My name is Max. I'm from Singapore. So I've been investing in the markets, using long-term investing for the last 3 years. So still pretty short track record, but so far I'm having a lot of fun and returns so far up to my own standard. So yeah, that's mainly about it. And I invest mainly in growth companies, not Singapore stocks, mainly US and international based markets.
Singapore growth, is that kind of what I'm hearing?
Okay, I don't want to go too specific on that.
Okay.
Yeah, but yeah.
I mean, yes. I hear you. And today we're going to talk about an interesting company in the sense that it is interesting as a business, but also interesting as in your take on the business because you bought into it. You were you were a strong believer of it, and then you sold your positions. Right, so I think that's the interesting transition that we're gonna elaborate as we evolve down today's discussion. But the company we're gonna talk about today is Peloton, right? So what is Peloton? What do they do? A lot of people will just think they're just a bike company. Share with us more.
Sure. So I think I'll start all the way from what exactly it is. So Peloton is a connected fitness company. That term is a very big label. So essentially what they do is they sell exercise equipment on a very bare bones basis that allows people to do like fitness classes via the internet. So I think these days, I'll just give a simple breakdown first from a layman perspective. Like in Singapore, they're not available in Singapore. But in Singapore, you see people attend like spin classes at the gyms, what have you. And then some people do it at home if their houses are big enough, landed, all those stuff where they can buy the exercise bike. And then what they do is that they then kind of get their phone or an iPad and then they go for a YouTube class, all the kind of stuff. And then so they kind of use that to kind of instruct them on to how to actually like keep fit and to do their cardio. So mainly Peloton, what it does is it sells exercise equipment. As of now, it's mainly an exercise bike, which is the spinning machine, and a treadmill that comes inbuilt with fitness classes, which means they come with their own LCD screen, which is big ass screen in terms of like instructors following you or teaching you how to follow them in terms of doing the classes with them or doing the exercises with them. And then of course they have other stuff like boot camps and all the physical strength workouts we can get into later, but mainly that's actually what they do from a bare bones basis. And then afterwards, maybe to go a bit into the details, so what is actually their business model is, they mainly generate revenue from two ways, right? The first way is what I talked about. They sell these hardware equipment. So the label that they use in their 10K or the annual report is called connected fitness products. So anytime you hear connected fitness products, it means it's selling the treadmill or the bike. And then the second thing, which is a smaller portion of their revenue. So the main money maker is still the connected fitness. And then the second portion is actually their monthly digital subscriptions. So because when you actually buy the bikes, you have to follow the classes, or you want to follow the classes, in fact, because their classes are quite interesting and quite outstanding, which we can go into later as well. But you pay a monthly recurring digital subscription that gives you access, like an all-access pass to the content and the classes and any new content that comes in. So two main revenue models. And now, of course, they have a tiny stream coming from apparel. They're kind of trying to go more into the lifestyle side of stuff. But I
sense
don't
a little bit of
really-
disdain there. Like apparel, 为什么?
Yeah.
Like what you hear.
Yeah, I mean, because of course, like it's always very skeptical whether some brand can be the next like Lululemon or the next Under Armour. It's a tough business lah. So I kind of like not taking that into account, even though some people would say, oh yeah, that's optionality. But at least as of my risk appetite or my investing analysis, I think that's not something that it's I see in the cards yet. So mainly two revenue models. Yeah.
Okay, cool. So I mean, apparel is not their core business anyway, right? So
Not yet. Yep.
yeah, it's interesting, about optionality. But I think let's focus a little bit on the connected fitness product, right? So I think a lot of times when companies come out with new terms, right, then the market have to kind of grapple around like connected fitness.
Yes.
Isn't it just a spin machine?
Yeah, you can say so, right? Yeah.
So how does that fare relative to their competitors? In the sense of like this machine, what's so unique about the product? Why are people raving over it?
I wanted to say I share that first, then I'll move into their competitors in the space, because this is a bit of a new industry.
Yes.
Right. So I would say the main competitors traditionally they're up against is actually your spin classes at the gym. Right, so your boutique gyms, or in Singapore, is also quite popular, given we're quite developed. People attend group spin classes together, or they go to the gym to work out. So that's mainly, I would say, the traditional competitor they're up against first and foremost, before we go into the connected fitness competitors. So I'll talk about the industry first. So the industry, first and foremost, the thing that they're mainly fighting is just conventional gyms and conventional spin classes. So I give a few examples. A few in Singapore, I don't think they're that popular, but there's a presence in Singapore here. There's this company known as Barry's Boot Camp. They do like boot camp classes. Yes, high end. Exactly, right? Barry's Boot Camp. Have you been, by the way, Barry's Boot Camp?
No, I'm not there target audience. But I have friends who are going there. I was like, wow, you go there 拍照 only like they always take photo, lighting very nice, everything.
It's quite atas actually. Yeah,
very atas, yes.
Yeah, but Barry's Boot Camp. But of course, a more direct competitor would be Soul Cycle in America, and of course, Orange Theory. So Orange Theory is this well-known boutique fitness classes. They have spin classes, exercise classes, what have you. So Soul Cycle, Barry's Boot Camp, Orange Theory. I just lump all these together for simplicity purposes. All these have a physical presence. So you have to go down to the fitness center or to the gym or to the boutique center, what have you, and then do the exercise alongside a bunch of whole sweaty people in the room and then an instructor in front and all that kind of stuff. So that's mainly what they're up against. And so the main, if you ask me, your question was what's different in terms of the value proposition. At first I was quite skeptical because this is just a like fitness equipment and then with a iPad in front, which is what most bears or most people would be a bit skeptical towards. And it's only when I start to do the math. So I give an example. So I'll just go into the numbers and then maybe you can just ask a bit if anywhere to get lost. Sure. So what happens is Peloton, their fitness bike. So they have this thing known as the Bike and the Bike Plus. The bike is the lower end version. So let's just assume that it's currently 1,500 because that's their main seller right now.
I know.
The
When
bike
I saw the
plus
bike
is
plus, I'm like, huh? Bike hiker
It's just-
inside plus, right?
yeah, dude, it's just a bigger screen. It's a bigger,
Yes.
much bigger screen. So there's a more what's the word? Panoramic experience, right?
Oh, okay.
But yeah.
Okay,
So the bike plus is 2.5K. But I'll just assume that we just use the bike so it's 1.5K. Previously it was about 2 point something K, and then over the last number of months they have lowered it a few times to lightly expand the TAM, which the management did say. So anyway, now it's 1.5K. So if you do the math, 1.5K, they allow all their customers to take up this thing known as a 39 months interest-free installment plan using this I would say this buy now pay later company that's big in the States known as Affirm. Right, but we won't go into that for now. But so most people, or at least more than 50% of their customers that buy the bikes, use the buy now pay later financing plan. So it breaks up the payment, and then plus after you do that, every month you must also pay $39 for the continual subscription of the classes, because otherwise it's just a bike that's useless, right? You won't go and get such an expensive bike. So all in all, if you add that up together, those amounts add up. So you take like 1,500 divided by 39 plus $39 per month. If you compare that amount to like a Barry's Bootcamp or a Soul Cycle, of course the range will depend and vary quite a bit, but for most of these boutique fitness classes, per class it's actually like close to actually $20-30 per class. Of course you can get the package, what have you, but when you compare that versus now per month, for Peloton you're paying like less than $100, and then of course you get unlimited classes and all these other things. And I forgot to add one thing, which is after my own due diligence in the Facebook groups and forums that I was looking at, or Reddit, they have the Peloton Reddit, the reason people find value there is because per membership, right, they allow up to 5 people per household, if I'm not wrong. Yeah, 5. So on average, based on their track record of them sharing per membership, per subscription, they have on average of 2.4 to 2.5 people per subscription, which means they're using it on a household basis. So when you divide that by you and your partner, it makes it even lesser. So that's from a monetary tangible standpoint, I hope it helps you see the main value proposition, which is $20-30 per class, versus like if you split between you and your partner, it can be less than $50 per month for unlimited classes. So that is the main value prop as to what makes them different from a numbers perspective. And then of course from a more intangible qualitative perspective, it would be a few things. Number one is of course you can actually do it like anytime, anywhere. You don't actually have to kind of like just go only for a certain time slot. So this is actually pretty interesting, which I can share because I don't have spin class experience. By the way, do you have spin class experience?
I don't have spin class experience.
You don't. Okay, so
but I walk past spin classes and I'm like, oh, this bunch of people crazy down there.
Yeah, exactly. But I'm not talking about just that experience on the class, right? But even pre-class. So I don't have spin class experience, even though it's been on my to-do list to go and attend one just for due diligence. But that aside, right? So the reason, let me just digress a bit. So the founder of this company, known as John Foley, his backstory for starting the company was because he was a busy executive at like Barnes and Nobles, and then like he couldn't find time to exercise, so he wanted to attend spin classes. The frustration comes when the split of these spin classes, the best instructors, right, normally their slots get taken up very fast. It's like the minute like maybe they only release the slots like 24 hours in advance. Once the bookings open, like within like 5 seconds, boom, it's full because people are like camping there to refresh the screen. And then when I asked a few of my female friends in Singapore to be full context, they also face the same thing. So I have some friends right now, female friends, who attend spin classes at Zouk, because Zouk is no longer the club that you know. It's now a exercise
post-pandemic,
studio.
Post-pandemic, guys. Yes,
exactly.
Big pivot. This one.
Yes. And they said the same thing, which gave me a bit of a okay. So what John Foley was saying, it actually isn't just a story he's crafting for investors. So they are very pissed also, some my friends, in the sense where sometimes the good instructors, if they only do the classes at 7 a.m. that day, you got to wake up early just for that class, and then go all the way down to Zoom, and you have to book it in advance. So it's very, very tough. So from a qualitative standpoint, because I already covered the numbers side, the qualitative side is that it allows you to attend classes anytime, anywhere without having to book it, because a lot of these instructors instructors. You can attend the live class, or you can attend the recorded class, because every content that's done live, it also goes into the recordings. So that whole content library is being built and built and built and built over the years as it amasses the quantity within. So those are a few reasons. Later we can talk more about the instructors and why I really love it and what was different about it that drew me to invest. But that's mainly from a general point of view. Yeah.
Okay. So can you give us a little bit of color, like what is the bulk of revenue coming from these bikes? And you did vividly say that 50% of the people that bought the bikes are buying on the installment plan.
Yes. Yeah.
Right?
So
that is the longer term cash flow.
Yeah, so actually the bulk of revenue from the company right now, right, close to 80% of their revenue came from the bikes, because I mentioned there's two revenue streams, bikes versus subscription monthly. So as of now, full company revenue, 80% comes from bikes. The latest quarter, though, it dropped to 60% for reasons we can get into later. But if I take that as an anomaly due to some difficulties or headwinds they're facing. But before that, generally they were about 70 to 80% across the board that makes up their full year revenue coming from the hardware. So it's not just the bikes, by the way, it's the bikes plus the treadmills. But the bikes is the main money maker now, because the treadmill is still a bit new and it's not yet penetrated well yet in the market. Yeah.
And there's some problems with the treadmill.
Yes. Yeah. Exactly.
That's what I heard. By
Very
the way,
nice.
guys, I just wanna slot here that there's a rooster outside in my house. So if you hear go, don't mind me. I'm in some like
I can't
European
hear
region.
though. I can't hear
great.
though.
That's great. That's good stuff. Good stuff. Okay. So about 80% comes from the bikes and and the treadmill, which for now is still problematic. We can talk a little bit about it. And the remaining, I would assume, comes from the monthly subscription.
Yes, correct. So the subscription revenue is the balance. Yeah.
Okay. So when we look at a business like this, we want to see the hardware sales continue to stay strong, and also the monthly subscription will then grow along with the hardware sales, right? Something along this line, right?
Got it. So actually, let me just chime in there a bit. Maybe yes and no. So there's a few different trains of thought, schools of thought. I can share mine as well. So obviously, because they are hardware companies. So traditionally for hardware company, investors or growth investors, most will not really look at it because we're all into that software and in the cloud kind of stuff. But the reason it was exciting was because of their growth rate for the hardware. It's like growing like 100% year on year before all this difficulties came in before that. So we're growing quite fast. And so the thesis that a lot of investors have is actually the hardware, even though it's the majority, it's a bit like what you said. You want the subscription to follow along, but eventually be able to kind of increase in percentage as well. Because the truth is your bike, it's only a one-time payment, but your subscription goes on for a long time, and we can get into the subscription later on as well if you want to probe. But the subscription, their churn is actually pretty attractive in a sense where the stickiness is very awesome for a consumer product. So their churn is about 0.8%, 0.7% hovers around there per month. So if you kind of just make it to like maybe in 1 year, it's like maybe like about 90% retention, which for a consumer product, I would say it's pretty off the charts, right? So what a lot of investors, at least the long-term bulls like myself included back then, is the main thesis was okay. Right, as in, I'll share that later.
Yes,
right, and that is you want the hardware to continue growing, but you want to see the software kind of increase in proportion, because the LT or the long-term value of like one single customer that you bring in can be pretty long because of the high stickiness or sticky retention rates. Yeah.
Okay, fair. I hear you on this. And are they looking to do a similar walled garden kind of strategy where the software and all the content is only tied to Peloton bikes? Or
it is. It's been a walled garden forever, which is what
forever.
Off,
so they don't plan to open it up and connect with other.
No. And from their strategy, you can see it's obvious. So they're trying to build another kind of aspirational brand. So the walled garden strategy is quite common.
Okay, cool. Yeah. So now let's expand a little bit on the subscription then. Why do you think it's like so amazing? I mean, based on what you are saying, it's like, oh, this is very, very good, blah, blah, blah.
Yeah.
Right? So I want to hear a little bit on that.
So I think I'll share the numbers, and then afterwards I'll share the qualitative as well.
Yeah.
So the numbers, I don't know whether the listeners can follow along with me just throwing out the numbers, but by the way, I'm looking at the spreadsheet, so it's not coming from my head also, so it's a lot easier for me. It's actually like, it's my own financial modeling, right? It's about 0.8% per month. This is the monthly net churn, 0.8 to 0.7% per month. Of course, there are some months it dropped to like 0.3, 0.4, but I'll just assume 0.8, 0.7. So if you're trying to analyze that to a year, it means in 1 year they have like a 88% or like a close to 90% retention rate. So based off that, it means that if you look at like the lifetime of a customer, assuming these numbers continue to hold, it will give you like a lifetime of close to like 100 months, okay, which about 8 years, which sounds borderline ridiculous because we can't envision that. Like, I can't imagine someone paying 8 years subscription non-stop for Peloton. But at least the numbers, if you want to use that, the numbers don't lie. So based off this, from that point of view, and then you times $39 per month times 12 months for 1 year times like 8 years, whatever, that amount in terms of the lifetime value, it's, I think I did a math, I don't have the calculator with me right now, it's about 2 point something K, right, $2,000 plus, versus their amount of sales and marketing spend, which is what we call the CAC, the customer acquisition cost. The sales and marketing spend to bring in a subscriber, it's at least right now, at max about $100 plus. Previously was about $200 plus, but even if you assume that previously $200 plus, the CAC of $250 versus a $2,000 long-term value, I think the numbers speak for itself in terms of the multiple from LTV to CAC. So that's why a lot of investors actually see that Peloton, or the bullish investors, Peloton is actually a hardware company, but behind that mask is actually a media subscription company, and that's why a lot of references, I'm not sure whether maybe Reggie you have maybe heard about it, a lot of references were drawn to Netflix as well.
Yeah.
And then of course, because of that, the bears that I know, that's bullshit. How can you compare this to Netflix? But actually, there is a lot of, I would say, similarities if you want to use a proxy for Netflix because of the subscription and the numbers making sense because of their stickiness.
Yeah, I mean, even Netflix itself says that it's not just about video consumption, right? They are competing with gaming, they are competing with news, they are competing with all the, because it's about attention, right? So if people spend a lot of time on Peloton, then in some ways they are a competitor. But I'm not sure if the day-to-day human thinks like that, like, oh yeah, I'm going to replace Netflix with Peloton. I'm not sure about that, right? So, but I hear you, and for a lot of people listening in, customer acquisition cost essentially is the cost to acquire the customer to come into the ecosystem and sign up, and then LTV is the assumed total amount that you can squeeze out of them, over their lifetime with you as a customer, right? But I have a question on this, right? Because I think certain businesses, LTV actualization is very high, right? In the sense that because they have time to prove out that, okay, yes, people do stay around, it really works. But this is a lot of assumption. Peloton is a young company. And there's a very big problem in this assumption is fitness trends, right? So fitness has trends, right? Like bar exercises, like yoga, like all those things, they have cycles. Right? Eventually they fade out and then there'll be new things that come in. Are you then concerned that the assumption in the LTV is overly optimized, like overly optimistic?
Yes, solid point. I would say yes. I was concerned at first before I took a position that is like, I mean, even though the numbers show that it's 8 years long-term lifetime value, but is that really possible? Like even I can't imagine myself riding a spinning bike for 8 years non-stop, right? I'll probably get bored. But then, so of course, then I started doing my own due diligence. So because if the numbers show you that, then you want to maybe dig deeper to try and disprove the numbers. So what I did was I went to research. And the good thing about these consumer businesses like Peloton is that you can really research because there are people posting their Facebook, YouTube, Reddit reviews, what have you. So Peloton actually has a free Facebook group online for their Peloton members. It's about a few 100,000 people inside. And so I joined that group to kind of spy. I joined their Reddit or their subreddit, their Peloton subreddit. And so this was the part that made me excited to kind of answer your question on that point, was because actually when you look at it, right, there are people, and it's not just one, it's like multiple people who have owned their Peloton for 3 years, 4 years coming, which even though it's not 8 years, it's still pretty insane. And then and these are not just They are not anomalies. It's actually quite common. And how do we know? It's because they will post their workout photo on the Facebook group and like, hey, it's been 4 years, blah blah. This thing has helped me fight cancer, what have you, all those kinds of stuff. And then in the subreddit also, you will have people who kind of share their experiences with the newbies who just came in about, oh, I've been here for 3 years, 4 years. And when I went to dig deeper in terms of a lot of reviews, WordPress sites, actually Peloton, even though it's a young company because it only was listed IPO in 2019, late 2019, but it actually tracked back all the way to, it started selling bikes pretty well in, I would say, 2015, 2016, about that. I might be off by a bit, but it's been some time. And so people actually do consistently stick to it. So seeing a few, of course, all these are anecdotal, to be fair, because I can't really do a survey. But I saw a lot of multiple occurrences of people who actually stuck to the thing for a long time. So that kind of made me feel a bit more assured. And then when I dug deeper into what makes the people stick, so I think that's where I kind of forgot to answer a question just now as to your question about the LTV, right? And that is from a qualitative side, put the numbers aside, the reason Peloton is so sticky, which until now they still are, is because of one thing. It's their instructors and their classes. So I'll just give you an example. From a fitness point of view, I mean, I'm sure most of us in our lives, Reggie, yourself, myself included, in our lives, at least once in a life, we have wanted to lose weight, correct? Okay, we all have tried that.
Recurring theme, not once in a life, right? Just saying.
Okay, got it. So the problem with losing weight or getting fit is what? It's always a means to an end, right? You follow? Like in the sense where people go for the workout, not because they like to work out, but because it's a terrible experience, but they just go through that so that you can hit that nice weight, that nice body, that healthier life that you crave or you desire. So it's always a means to an end. But when I was looking through a lot of these Peloton reviews on YouTube, Facebook, Reddit, all these stuff, the Peloton experience is an end in itself. So people go for the bike because it's fun. It's fun and it's energizing. And then I went to see a few of the classes on YouTube. So once again, it's purely walled garden. It's only some people, they just record snippets of the class and they put online. It's pretty much like going to, I use an example which just ask me to explain more if you can't really get it. It's a combination of a fitness class plus a dance club plus a motivational seminar plus church and plus a theatre play all in one. Like I give you an example, they have a lot of different types of personalities in their instructor team. You have this guy named Cody Rixby. He's like a sassy guy, very, very fun guy, always talking about him being gay and very, very open about it. And then like the ladies just love him. He talks very, very in a very sassy manner, a bit like if you have watched, what's that movie? Some white chicks or something like a character out from that movie, and he attracts a lot of the females and the ladies. And then every time on the bike, as you imagine you're exercising, you're very tired, he's talking about him and his boyfriend going out on a hot date and all sorts of funny stuff, and so you're laughing and getting entertained while sweating. And then plus they use like a lot of music, so they have a lot of tie-ups, which is a big bulk of their spend. Partnerships with like Beyonce, they have like Michael Jackson, right? It's Britney Spears right now. Of course, they will zeng the thing a bit to have their own like like a bit of a different feel. So it's a mixture of dance club, all these things add together. And then of course, along the way, they will tell you some motivational quotes like, "Okay, guys, as you're tired, remember why you started." All these kinds of very trite examples. And then plus, because of the nature of the business model, right? Like example, sometimes when and maybe if you guys have time, you can check out the Facebook group. This is very common, by the way. Somebody's mother died in a fire. Somebody's kid died because of an accident. Very sad example. They would post all these photos of their kids on the Peloton Facebook group, that free Facebook group. And that Facebook group is moderated by, I think, a ton of their own moderators looking through. And if they see this coming from a member, they will likely search the member's name and then check this member book what live class next tomorrow, and then they see who's the instructor, and they will find all these very strong highlights that can really be very memorable. They will tell the instructor, hey, yesterday Jenny posted on the Facebook group, her mom just died. I want you to do a shout out for her. So their whole class is all scripted and very, very theatre, like which people don't know. Like it's not just a gym class where live gyms, people just, it's all like spontaneous, right? So it's all planned. And so like the instructor will have like, at the 39th minute when this track from Michael Jackson plays, I'm gonna say, hey, Jennifer, just want to give a shout out. I know it's tough for you, but ride on, we're all with you. And then like you can see people, they post, oh my goodness, the instructor called me out today and I just cried while riding. So I hope this gives you the essence of like, it's church, motivational seminar, dance club, fitness class, all tied up in one. To answer the question, I gave a very long-winded answer as to why the stickiness is there. So because of those factors, it allowed me to feel a bit more assured. I wouldn't say I'm confident they can last 8 years, but I'm more assured that the churn is what it says on numbers. Yeah.
Interesting. I mean, very cultish, very spiritual.
Oh, yes.
Very
That's a good word.
cultish.
Yeah.
I'm not saying that it's definitely a bad thing, but it's just the very essence of a cult, right? But in a business view, it's not a bad thing. I mean, we put our morality aside, right? Just looking at the churn in itself, right? But I would say, for all you listening, maybe you still got to see for a little bit longer. But okay, if the clarity comes along, then prices will reflect in itself already, right? So maybe you will not be as advanced, right? But the reality is, I do think churn rate will increase exponentially in the later part of their life cycle as a customer, right? More people will drop off.
That's a fair point.
Yeah, that's very standard, I would say. But also one thing about their content spend. They do spend the highest relative to all the other guys. Spotify, Netflix, YouTube, Apple, everybody, they do spend the highest per stream. Right, so they do pay content creators the most. I'm not sure how that will play out. Do you have any thoughts on that?
Yeah, I have. So actually, this people see as a downside, right? I actually like that. So to mention, because you mentioned there are competitors, Netflix, Spotify, but actually I wouldn't say those are competitors because those are like totally different business model, right? They're main competitors in this industry.
But they buy from the same creators, right?
So they have in some ways, but of course they have like licensing agreements and partnerships with like Spotify as well. So it's not exactly a competitor. But so their main competitors are a few bike companies known as Nordic Trek, Echelon Bikes. All these are just like different variations, and then of course Apple Fitness. So Apple's also go into that. The main reason, if you go and look at the Instagram pages of the companies, and so all these companies also have their own instructors. Like the reason the fan following, like you've said a very good word, which is the cult-like following that Peloton's instructors have, which is actually their main mode because that's what customers go back for because of the personality and the connection with the instructors versus instructors from Echelon, Nordic, or Apple Fitness. It's mainly because of the content spend. So Peloton spends a lot of money on like hiring the best people to make their content. They spend a lot of money on music licensing, which is a very big bulk of their content versus a typical class from a competitor that just uses some random Tom, Dick, Harry, Chapalang music, right? And then the thing that I think I was quite impressed by, which of course is what you mentioned, that is content spend, is it a concern? Yes. But I was quite impressed by when I was doing a bit of digging, and actually people, this one I think they are not supposed to say, but there's always a backdoor person who will come out and share. Peloton, almost every class is purely scripted from start to finish, which is, when I first heard it, I was like, wow, okay, that's pretty insane, because you mentioned there's some ethical concerns there as well, but I mean I see it as like it's just theatre and so it's scripted from start to finish, and they hire Hollywood producers or people from Hollywood to script their classes. So there's stuff like are you aware of this thing known as the hero's journey, where in storytelling the hero goes through the arc, right? They do the same thing. So even though the class, you might think, oh, it's just a spin class, innocently go inside, actually there's a lot of scripting that goes in to kind of make you go through the ups and downs, the highs, feel the inspiration, at the bad low where you feel damn tired, kind of push you a bit. And so all these content spend add up. But to me, I want to see that, because otherwise then they are not going to be any different from their competitors, isn't it? Anyone can just get a bike and an iPad and an instructor. What makes them different? It's this spend and their partnerships that they have built over time. Yeah.
Okay. So then I think the next important question about this particular thing is, how long do they have absolute exclusivity to all these trainers? This is important,
So,
right? Yes.
Yeah, correct. Yeah, so obviously this one, I don't have the perfect answer lah, to be fair, which is why their spend on music is actually one of their highest spend. Their spend with this Beyonce, Michael Jackson, Britney Spears is one of the highest spend. So that's why I think the market is concerned. Yeah.
Yeah, are they then able to successfully keep creating new personalities, like new coaches and new? That's important.
Yes. Bingo. Yeah. So that actually is one of the. So my investing philosophy is normally when I want to invest in a company, I'll break the company down into like three key variables, or 3 to 4, depending on like how many that I can find to try and track the company for. So you actually know a very solid point, Reggie. One of the variables I look for is its ability to churn out stars. Right, celebrities are stars. Because like the mention, because we mentioned, if the moat that the company has is the connection that people have with these personas on the bikes, which is the instructors, then if this instructor leaves, then they are screwed. They're really screwed. So I want to see their ability to churn out stars, which means, just from what I just said, those people that really understand this, which is not easy to understand. Actually, Peloton is not even a hardware company. It's a media company. It's like a under the radar Hollywood kind of, like, it just needs to be able to churn out your Robert Downey Jr.'s, your actors, actresses, what have you, Johnny Depp's, right? And so that was my initial concern, that I have. They just have a few, 1 or 2 stars lined up. But over the last few years, hey, they have churned out a few new stars. And if you follow the Instagram page, the following, right, on a week-to-week or month-on-month basis, it's actually picking up trend in an accelerated manner as well. So their ability to kind of build up the persona of these instructors to become like celebrities is actually there. So initially in the early days was just a few instructors, a few of them, their names are Cody Rigsby, Ellie Love, a few of these people. Today they have so many more from different countries as well. So it tells me that they have the system there. And of course I went to do a bit of digging on Twitter, speaking to a few other investors and a few other on the ground researchers as well of the company. So their process for building up the instructors is actually pretty insane. So it's a very high bar. So when the instructors first come in, so what they will do, right, is they will send out certain talent scouts to go attend spin classes from Orange Theory and Soul Cycle, really. And then they will kind of track these people. One of their instructors, his name is called Ben Aldis, came from this way, where one of their talent scouts went down to his class. That guy was giving a fitness class in one of the boutique gyms. After the class ended, he just approached the guy and like, hey, would you be interested in having a different type of arrangement for fitness that could really change your life? Something like this. Just the opening.
Very K-pop.
Yeah.
Yes.
Hired the guy from there. And then through that, they go through like a 6-month probation period, also a training period, which is pretty intense. And then afterwards, a lot of their instructors, right, the part that gave me a lot of excitement, so I think I'm going to be overly bullish here through my sharings, is that it's like they don't come from instructor backgrounds. A lot of their instructors, just now I give the example, was a bit of an anomaly. Quite a number of their instructors come from backgrounds with zero fitness experience. So a few of their best instructors right now are dancers, lawyers. So they like to hire people with a certain stage personality who already have the ability to, what we call rah-rah a crowd. Because the training or the fitness part can teach. Yeah,
I get it. And I love how lawyers are part of the rah-rah. Anyway, that's a discussion for another time. But yes, I think that's an important thing for listeners to take note, because as with many other sectors that are, very, very anchored on celebrities, or anchored on personalities, like live stream selling stuff, or even like K-pop directly, you really got to see how well the company can keep churning, new people. And if they cannot, then it's a little bit of an issue, right? Because they get tied down by the personalities.
Correct.
Yeah, and I think through the pandemic, everybody kind of tie Peloton as a pandemic play, right? Because I mean, for the past 2 years, you see revenue fly, right? Hundreds of percent, moving up, in itself, right? So what is the play then going forward post-pandemic, right? Are you expecting them to slow down, and I also see gross profit like dwindling, right? So I want to get the
revenue slowing down. So this one, I think I'll be very upfront as well. I don't have I'm still struggling to find an answer, which is why I exited. So maybe we can gradually move into that side. Okay. So generally, right? So I'll share the before after. The before after in the sense before I exited. Okay. So before I exited, through my own research, because it's like, is this a COVID stock? Is this a COVID play? So very concerned. And then through a lot of the analyst calls that the management team does with these analysts from like Bank of America, what have you, or these conferences, and in the quarterly earnings as well, they actually share their stats and also in their earnings presentation. Throughout the last few years of people who, of all the total Peloton users currently that they had back then, that they surveyed, 4 out of 5 did not come from a gym. You get my point? So initially my take was, if this is a COVID stock, it means that people, because they cannot go to the gym, then they buy the bike to kind of use as a, what we call a substitute, or like people who are already in the fitness market. But 4 out of 5 of their current users did not come from a gym, and majority of their users are not in the market for fitness equipment, which means how did they come across it? It's really through word of mouth, and this one I have to give it to them. Their word of mouth is really solid and strong. There's a lot of pull factor rather than push from advertising, even though they're starting to ramp up the advertising engine already, but a lot of pull factor from consumer to consumer to consumer. And so because of that, when I look at those factors, I'm like, okay. And during the pandemic itself, right, they actually didn't spend much on marketing. They actually openly said, if you see their spend on sales and marketing, previously pre-pandemic was like 20+%. During pandemic, it dropped to like 12-13%. You might think it's a bit silly, right? Because pandemic, they should be capitalizing. But there's one reason they didn't do that, and it's unfortunate, is because they didn't expect the pandemic to happen. Nobody saw that. So the supply chain cannot cope. So because the supply chain cannot cope, they didn't want to like rev the marketing engine. So they held back. So mainly came from word of mouth. So it's because of those factors that helped make me realize this is still the past, that I don't think they are a COVID play. But then now moving on to the present or the current or like the latest quarter, the reason the stock fell like 40% in a week or something like that is because of the management team in the earnings call. For the first time, they showed a lot of weakness. Previously, most earnings call, they are normally quite confident. There's always a few hiccups here and there, but not generally very confident. They show a lot of uncertainty. So John Foley, who's the CEO, mentioned that they actually overestimated the recovery, overestimated demand after the recovery of the pandemic. So right now, that since places are all opening up, they overestimated more foot traffic into their stores that they sell the Peloton from. So similar to Apple and Tesla, they have their own stores. They don't sell through third-party distributors, all this. Also their own stores. They overestimated foot traffic. They also overestimated site traffic. So they didn't expect it to drop so much, but it dropped by more than they expected. So because of that, this is obviously COVID happening already, and of course because of summer, because the US, the summertime is from like May all the way to like around like the spring, which is October period, and then like December. So because of those factors, that's why the revenue took a hit, and that's why they guided for such a terrible guidance, and that's why the whole stock came up, because of the poor revenue expectation. So to answer your question, I don't have the perfect answer. Previously, I was quite confident because of what they said, but in the recent quarter, they also sounded uncertain of moving forward, whether there's actually a lot of COVID tailwinds pushing them up. So my perspective is, because of the strong customer love for the product, I still think they'll be around for a long time. But I would say COVID did play a role in pushing them up or giving them a strong advantage doing that. And can they maintain that? As of now, looks like likely not. Yeah.
Okay. Why do you think likely not?
Okay, so it's when I say as of now, which means because of the recent stuff that happened, and so maybe we can get into why I exited, right? A few reasons. So number one is because they, like I mentioned, right, they already mentioned, or like John Foley mentioned, that they overestimated the demand. That's number one. Secondly, and this is something more towards the execution wise, they are supposed to kind of so it's always been on their cards to, like, they keep saying that 2021, which is financial year 2022, which is right now 2021, because their financial year is normally like a few months in advance of the actual year. It's the year for the tread. And then we can get into the tread now. And that is because of the accident with the toddler there's a toddler that had accident, got killed because of a treadmill. They had to pull back the tread, recall, and then do a few things. But even after that, they are supposed to roll out the track, and they have rolled out the track. It's not taking place at the speed that it's supposed to, or they said that it would. And granted, I get it. Companies they have speed bumps on the road, they have hiccups. I get it. We're supposed to zoom out a little bit, but just with this alone, it's very slow in the execution. And then they are supposed to kind of have, or at least in the cards, a few other hardware that they plan to roll out. It's all pretty slow in the terms of innovation. So the reason I said why I'm a bit unconfident is because even if let's say the fitness trends continue, let's say this demand still continues, but their ability to kind of roll that out makes me feel uncertain, and so that's why I had weakness in my position. Yeah.
Okay, so how will you then rate management? Sounds like there are a lot of management problems at this point in time.
Yeah. So you're making me come to terms with shooting myself also, right? So I really love the founder. His name is called John Foley, because a part of my investment research process or my own style is before I invest in a company, I will spend like at least a few weeks watching all their interviews on YouTube and Spotify interviews, podcasts, to kind of understand this person's character. So this guy he's a fighter. So to give some context, when he first launched Peloton, people didn't believe, because it's just who the heck would buy hardware on a bike? Every VC back then wanted to fund stuff around software, correct? So he went through, I think if I'm not wrong, I could be off. Is it hundreds or thousands of rejections before he got his first VC funding, whatever? So this guy is a fighter that really believes in the mission. So I love him for everything that I've researched on him so far. But as of late, the execution as a team. So I wouldn't really know whether you can grant it's his fault exactly, but I would say yes, because as the CEO, I would still put you responsible. That is, the ability to innovate and to execute these things are not there. And the part that I think I was quite disappointed, to be fair, was on the earnings call, the latest earnings call, which is just last month. An analyst actually asked them, say, hey, given that you guys are lowering the prices of your bike in order to kind of sell more, and so your gross margins are coming down, do you likely need to raise more money to kind of fund your business? Because like you mentioned, they have a high expenditure on music and content, right? And they said no, actually, as of the cash balances that we have and the revolving loans, or the revolving loans that we have from the banks, revolving credit, that we have, the credit faculty, we are good, we don't need. And then what the hell, just 1 week after the earnings call, you raise capital. So in the earnings call, they said, we don't need, and we don't foresee a capital raise, and they did that. So I get it if the company needs cash, but when you sound so certain that you don't need, and then 1 week later you do 180 on us as investors, it calls to question, maybe not integrity, because I think this guy is quite really he's for the business, but it just tells me even you yourself are not sure of the needs for your own business. What more me as an investor?
Yes. And this reminds me of Kevin Plank from Under Armour. Right, so Under Armour is the same
it's a tough
situation,
business.
right?
Yeah.
Like when they rode, they flew. They were everywhere, and then they grew and grew and grew. Every quarter, 20% growth, right? And they hit a very, very bad situation where they over-indented. They had supply chain problems after that, and they couldn't shed their stock. In terms of all the stuff
inventory
that they had, right? So inventory problem, and then it just spiral, and to where it is today, So do you think it's a situation where the team doesn't have enough talent in the sense of operation? Because managing supply chain is very complicated. That's one thing.
Yeah.
And in Under Armour at that point in time, they didn't have someone that is very good with operations. And what are your thoughts on this part, beyond just the founder?
I would say yes to answer your question. And that's because if I look at, same thing, I can't look at the future, I can only look at the track record, right? Even though, this CEO is someone that I love for his grit and his resilience. But first of all, during COVID, now granted, I know nobody saw COVID coming, but the supply chain issues was a mess, of course, a complete mess. So to give some context, typically what we call the OTD, on-time delivery window, it's a term in the manufacturing industry for these kinds of supply chains. Their previous OTD for the bikes before COVID was just maybe 1 to 3 weeks, about there. right?
Okay.
During COVID, it went up to as high as like 2 months or even 3 months in certain crazy periods or certain states where it's a bit harder for the third party logistics or for their own vans to reach because of supply chain. So it became like, which is why, like I mentioned just now, they couldn't ramp up marketing because of fulfillment issues. So that's number one. They had to spend 100.
Question on this. Did they increase their spend? Excuse me. Did they increase their spend to try to get this going? Like
Yes.
reduce their margin during this period of time?
So I was going to go there. Yeah. They spent $100 million in order to kind of expedite the shipping via air freight, because most of their bikes came from this factory in Taiwan. It's from Xinji, Taiwan. It's this factory known as this tonic. It's called Tonic Plant. So anyway, long story short, the bikes normally come from Taiwan. So because of this, I think it comes by another method, maybe boat or whatever. But because of this, they spent 100 million, which you are right, it ate into their margins. And so because of this, their margins took a hit. Operating margin, gross margin all took a hit. And so because of this, it tells me that wow, 100 million is a lot. Quite a fair bit, I think, to spend on supply chain. So that's during the pandemic. But investors were all closing one eye, myself included, because the revenue was still growing like bonkers. Right? So that's a supply chain issue they faced already. And but of course, to be fair to them, a lot of the other competitors that I listened to the interviews of those companies' CEOs who are also in the connected fitness business all face supply chain issues. So granted, maybe I want to be fair there. But right now also you have another issue regarding execution of these products, rolling out of these threads, what have you. That's the second time these supply chains are coming up again. So maybe could you say, it's because of the accident, because of the baby died at the treadmill, we had to recall, and then the approval from the authorities is taking longer than expected. Yeah, maybe. But I think from an investing point of view, where I place my money is important. When I see stuff like that, recurring theme is execution around supply chain. To answer your question, it's yes. I think they may lack good supply chain operational strategists or executives on their team. And so that should be what they're trying to solve. But yeah, I don't have the best answers to how they're going to do it yet as of now.
Fair. So I think we hear a lot of challenges coming up, right, with supply chain, also with the changing consumer habits going forward, because like pandemic, it's kind of post-pandemic in a lot of places. In Singapore still, but in a lot of places it's already post-pandemic. So you want to see the consumer habits, how do they develop over time, right? So maybe in the last things that you can share with us, like give us some concrete idea, what are some of the risk factors, and why did you then decide to leave the company?
Okay.
Like just let's take a break from this.
Okay, so it ties in nicely because I left it obviously because of risk factors, right? Actually, I kind of covered most of them already, but I think to give a quick background as to why I left. Okay, so I would not have exited the position if not for my style of portfolio allocation. So just a quick background, even though it may not be part of this podcast.
No, it's important.
I have a pretty concentrated portfolio. How concentrated? I'm talking about like 7 to 8 stocks, but the top 4 can take up like 80-90% of it. So because of that, and Peloton was one of those concentrated positions. If today I have a diversified portfolio of like maybe like your Peter Lynch, what have you, right? Like few hundred, or maybe like even like 50, 60, I can afford to let it stay there. And if you ask me, right, I think I would let it stay there, because I still believe, like if I ask myself fundamentally, the Buffett saying back then, American Express and the oil scandal, like fundamentally, did anything change in the business? Okay, execution wise, yes, their execution got problem, but is the product love still strong? Yes. Is the customer still using the product at the same rate? Yes. Even though there's seasonality from summer to winter, but yes, there is no anger or poor customer service, whatever. It's still the same level of customer raving, cult-like fan level of excitement for that. So it's still there. So if I have a more diversified portfolio, I would have left it there, because I really believe in the long run, but long run, who knows how many years, it will still go back and eventually still continue to grow. But the problem was that because of my concentration, I don't know how long it's going to be stuck there. And when I consider opportunity cost, right, like, hey, I can put my money in other companies that I have a lot more confidence, I have a lot more clarity on the management, execution, and direction for the next few years, why would I want to keep the money there? So that's why I took the loss, and that's quite a heavy loss for me. But from a whole portfolio, it's still fine. And so, yeah, I think to answer your question from a more management level, a few things. Number one, three reasons why I left, right? Number one, as a management team, if you yourself are telling me that you don't have an idea of your forecast for your website traffic on your store traffic for the next coming months, which they openly said, then what more me as an investor? I mean, I can do all the scuttlebutt that I want, right? Even you yourself are not clear. How would I be clear? So that was a big red flag for me. Number two, you did a capital raise when you said you didn't. So put the execution stuff aside. Even your own financial situation, you're not clear, man. You get my point? Like you did a capital raise. Like, once again, I say it's okay to do a capital raise. But when you say you don't need and you do it 1 week later, there's a problem there, man. Thirdly, the day after they released the earnings, I think they timed this also. They released a report, and I think this one got leaked openly to the public, but I think they knew that was going to get leaked anyway. They have temporarily stopped all hiring. They have stopped all hiring across the board for their company because of the fact that expenses are increasing, right? They spend a lot of expenses. They overexpended during COVID. And like I mentioned, right, this ties into my first point as to how they overestimated demand. So they're a bit bloated right now. They're trying to cut costs. So from my perspective, it's just one thing. This is very clear. It's like, this is not what a growth company, at least in the medium term, should look like. Once again, in the long term, can they grow? I would say yes, because I still love the company, right? But same thing, if just you're cutting costs, this is not what a growth company looks like. And for my style of investing, if the revenue doesn't grow, the price will not move, or like even though I don't want to talk about price here because you want to think long term, but same thing, my money will be a big opportunity cost there. So it's for those three reasons that my lack of belief and faith in the management team now, that I'm exiting the position. And those are the risks. It's mainly the management and of course the ability to understand their business and do the operational stuff. Yep.
Fair. I hear you, and I foresee more capital raising from the company, just from the financials. I see the financials like 不可能 Their cash flow.
Spot on.
Their cash flow is problematic at this point in time. Their cash position is not rich. They have some space for debt, because their debt positions are not high, but they're already starting to raise debt. So to continue to move, they will have to raise more equity. So I think for all you listening, very likely you will see more dilution. So if you're interested in a company, you can wait a little longer.
Yeah, correct. You actually nailed all the points I had in mind here.
Great, cool. Yes, so I think we had a great discussion from the whole thought process as to why you bought it, all the way to why you sell it. I think this is a great discussion, to try to get people to see this whole part of like, okay, as an investor, because of my style, I decided to drop it because of what, right? Does not mean the company inherently is not a good company, but that also does not mean that it is not facing a lot of problems in the medium term, at least.
Okay, so can I chime in something regarding portfolio allocation, just at least, because I think it's very crucial. Because I mean, it's quite a raw wound that I'm still facing, right? So I just want to add the upside, add the point that you made about So in the medium short term, they're going to raise more capital. Your price is going to get worse because of the dilution. And so I think the fortunate thing for me was that, even though, yes, I took a big hit on this, my full portfolio amount that I lost was just like 4%. And I'm going to give some context to why I'm mentioning this. So thankfully for position sizing, I'm still able to have the courage needed to exit. But because I think Twitter, there's a lot of Peloton bulls. So I'm actually in touch with some of them. Like we DM each other. I know people who are in Peloton, one stock all in. And so they are down I don't want to go so much into the details as to who they are, but they are down close to 1 million. And you just think for a second, when you're down 1 million in a stock, right? Okay, unless maybe you have a lot of nerves of steel, there is no way you're going to say, let me just exit and redeploy. No way. When you're down 1 million. And so my point was that I think the lesson here, if whoever's listening, is that even if you like a company, may not be Peloton, or you don't like the company, whatever, or maybe if you like the company, I think the sizing is still so crucial, no matter how bullish. And I think that's something I was very fortunate to still stick to the discipline with in some way, because if I had gone all in onto that, I would not even have the mood to be doing this podcast with you today, right? Yeah. So I think it's an important lesson to take away beyond just the company. Yeah. Sorry to cut you off. Yeah.
No, great.
Yeah,
I think that's
yeah.
a good discussion, and we should probably continue the discussion in portfolio allocation in our other segment on Chills with TSC.
Sure.
I will get the editorial team to contact you.
Sure.
So yes, thank you for coming in with us, and I hope to see you again, with another company maybe slightly down the road. Okay.
Thank you, Reggie, for having me. Thank you.
Awesome. Bye.
Thank you. Bye bye.